An unchanged market yesterday. Will there be more movement today? So far, the screens say no. 30 minutes until the start of cash equity trading. I'm Dani Berger. Matt Miller is on assignment. Bloomberg Open Interest starts right now. Coming up, a Bloomberg scoop. Anthropic and Google are in talks for a multi-billion-dollar cloud deal. And the Fed floats a plan for much smaller capital hikes for Wall Street's biggest banks. Plus, the latest meme stock darling, Beyond Meat, surges, boosting its 4-day rally to almost 1,300%. So the Meme-Mania is back. There are corners of this market that I guess are just manic. It's not true everywhere. Some of the stocks that we're watching this morning, Netflix down 7.6% in the pre-market. They said a tax dispute with Brazil cut into their third quarter earnings that otherwise would have beat estimates. Then there was Mattel, also a disappointment, down 5.33%. They said that retailers were delaying orders because of tariff uncertainty, despite the fact people are still buying things. Alphabet shares, those are up 2.3%. They are in talks with Anthropic for a cloud deal that is valued in the high tens of billions of dollars. More on that story because Bloomberg Tech co-host Ed Ludlow broke that news and joins us now. Ed, what do we know about how this deal will look?
Yeah, it's an arrangement for cloud computing capacity. These are early talks. But you're right, the scale is in the high tens of billions of dollars, which gives you a sense of the capacity that they're talking about. That's kind of multi-gigawatt scale. One source told me that tensor processing units, or Google's TPUs, are the focus of the conversation. And the main point with that is that largely it's seen as a great advantage for Google. These customized chips that accelerate machine learning and AI processes. And, the share's up 2% in pre-market, but it was really interesting to see the reaction in aftermarket as well. Both Alphabet moving to the upside and Amazon moving to the downside.
Talk about that Amazon piece, because Amazon is also an investor in Anthropic. How does this change that relationship?
Yeah, it's really difficult to read the tea leaves on this one. Like, is the deal where we have one source telling us that TPUs are the focus of it because Anthropic just generally needs more capacity? We know that Dario Amodei, the CEO, has been doing a tour of the Middle East recently, asking for both capital and capacity. Or is this about an issue with the relationship with Amazon? So Amazon has pledged to invest about $8 billion into Anthropic. Anthropic actually uses Amazon's Bedrock service on AWS as a pretty important sales channel. It's a platform where developers can go and access Anthropic's models. And for both parties, that's been beneficial. And then the third piece of it is Amazon building custom infrastructure for Anthropic workloads, Project Rainier, which is in South Bend, Indiana. And so we've had a lot of questions this morning. One of those is on that third piece, is that not working? Is there some kind of technical issue? Or is it the bigger picture that Anthropic, like OpenAI, just is foreseeing this great demand need, and everyone right now is supply constrained when it comes to capacity?
Hey, Ed, fantastic reporting. We're looking forward to watching you cover this more at 11 a.m. on Bloomberg Tech. That is, of course, the co-host of Bloomberg Tech, Ed Ludlow. Now, on the earnings front, Netflix says that a tax dispute with Brazil cut into their third quarter earnings. That marred results that otherwise did fall in line with Wall Street estimates. Bloomberg also reporting that Netflix is weighing a bid for parts of Warner Brothers Discovery. Co-CEO Ted Sarandos addressed the possible acquisition.
We've been very clear in the past that we have no interest in owning legacy media networks, so there's no change there. But in general, we believe that we can be and we will be choosy. We have a great business. We're predominantly focused on growing organically, investing aggressively and responsibly into the growth, and returning excess cash flow to shareholders through our share repurchase.
Joining us now is Bloomberg media reporter Hannah Miller. Hannah, we'll set possible acquisitions aside for just one moment, but Netflix is having a really rough day in the pre-market. How much of that is about the tax issue versus a really strong lineup that maybe should have produced better results?
Yeah, I think that tax dispute really weighed on them, and investors are a little bit concerned, a little bit disappointed in what we saw with earnings. After all, they had a really strong lineup this past quarter, including a smash hit, K-pop Demon Hunters.
And they had live sports. They had that boxing match. So what does it mean that they had a weaker quarter? Again, is it just the tax thing, or should it have, as a whole, been better because of K-pop and boxing and whatever else they have?
You know, they're arguing that it's this tax settlement, but, you know, there's also other issues in media. You know, there is concern about AI, what that means for the film industry, what that means for actors and other talent. So investors are looking at that. And, you know, the media industry in general is just struggling.
It's struggling and maybe has big changes coming to it, especially with Warner Brothers Discovery. What did you make of Ted Sarandos' comments there, saying we're still not interested in legacy media, but we're choosy and maybe we do look at something?
You know, Warner Brothers has great IP. It has the studio. You know, it has the lot. So those could be appealing assets to Netflix. But yeah, they want no part of cable networks like CNN, TNT.
Do you have any understanding as to whether Warner Brothers Discovery would just sell off a piece of, for example, their streaming business, or if this is a deal, do you have to take the whole thing? And would that actually be of interest to Netflix?
I think that's the biggest question here. Is Warner Brothers going to be sold in whole? Are they going to go through with the separation of their two businesses, or are they going to sell off parts? We know Paramount has already submitted a bid for all of Warner Brothers that was rejected for being too low. We know Netflix would want a piece of it, and Comcast is another potentially interested party.
How much of this, though, is them just going to market, kind of nudging Skydance, Paramount, saying, you better pay up more for us if you want it?
Yeah, they're sparking a bidding war here. You know, we've had Paramount come in. They are dealing with their own changes right now after going through an $8 billion merger over the summer. So there are a lot of changes happening here, and there's real potential for consolidation of both movie studios and streaming.
All right. Thank you so much, Hannah. That is Hannah Miller of our Bloomberg team on the latest Netflix earnings and the talk of Warner Brothers Discovery sale. Now, we had some news breaking in the last hour. Bloomberg reporting that the Fed has shown regulators the outline of a revised plan that would dramatically relax a Biden-era banking capital proposal for Wall Street's largest lenders. Joining us now is Michael Moore, managing editor for Bloomberg News. Michael, in what they discussed and what the team over at Bloomberg has seen, what could those capital requirements look like?
Yeah, so when the Biden-era regulators first rolled out this proposal a couple years ago, the biggest banks were looking at a 19% jump in their capital requirements, which they were quite livid about, the pushback forcefully on. This revised proposal, the early calculations are looking at a 3 to 7% increase in the capital that they'd have to hold. So much reduced. And, you know, there was a compromise version that was floated last year with a 9% increase, so even below that. So the devil's always in the details. These proposals can run thousands of pages, and this is just a broad outline of what they want to do, but certainly it's in the directions that banks
How big of a
want.
gulf is that between 3 and 7%? What would those numbers mean, and how would their fortunes change on either end for the big banks?
Yeah, and that's an aggregate number. You know, individual banks could be looking based on their business mix and looking at different figures. We said some of the ones with larger trading portfolios, it could be even lower than that 3% figure. So I think it'll depend on which bank and a lot of the details that will come through. You know, the proposal is not expected until the first half of next year. So I think you are going to see a lot of questions, but certainly banks will be encouraged by this direction.
Just overall in this banking environment, we had earnings from Western Alliance after the bell yesterday. Before that, it was Zion's, both of them reporting robust earnings. You also had Capital One that had solid earnings too, even saying that their auto lending business, that was also strong too. There's some of their more, you know, subprime lenders still looked okay. Can we set aside some of the credit fears after this earnings season?
I think for now people are a little calmer. You know, obviously on Thursday, you had a couple of banks reporting hits tied to a specific incident, and that was, you know, 3 in the course of a month, you know, which got people a little edgy. The sell-off was quite rapid, but we've seen in the last few days, you know, a rebound from that. Banks coming out and saying, actually, overall provisions are quite good. There's some one-off situations, but the credit, both on the corporate side and the consumer side, is holding up okay.
All right, Michael, thank you so much for joining this morning. Always a pleasure having you on. That's Michael Moore, Bloomberg Finance Executive Editor. A quick check on futures this morning. So the move yesterday, you had to go out to an 1,000th of a percent to see a move. 0.003% is how we ended the S&P 500 session higher yesterday. It looks like another calm day. I mean, it is only 9:10 a.m., so that could easily change. But at the moment, still little change on the S&P. NASDAQ sinks by 0.1%. It is Netflix seemingly moving that lower. Meanwhile, the Russell 2000 index falls yet again after underperforming yesterday. It was down 0.5% today, down 0.3% today, despite the fact you do see government bond yields coming in. Right, let's take a look at some of the other movers this morning. More earnings to get through. AT&T said it added 405,000 new mobile phone customers in the third quarter. That did top estimates as summer promotions paid off. But how much of that was just about promotions? That will not last. Shares falling 2%. Meanwhile, Hilton lowered its full-year outlook. Demand for U.S. hotel bookings continues to fall, but they did raise some other parts of their financial guidance, saying that some stability in policy, be it tax policy or other geopolitical policy, and lower rates will help them going forward. Shares up 2.3%. Texas Instruments, they gave a disappointing forecast, and it suggested that customers are slowing orders, specifically the CEO pointing out industrial companies in a wait-and-see mode as they navigate trade tensions and a shaky economy. Shares off almost 9%. Coming up, more on Netflix. We'll talk with analyst Robert Fishman of Moffettnathanson. That's coming up next on Bloomberg Open Interest. Let's look at some high interest stories. What's making headlines around the world? The government shutdown has stretched into its 22nd day. That is the second longest on record. Negotiations are stuck over renewing health care subsidies. Federal workers are set to miss their first full paycheck on Friday. Officials warn that continued delays could also disrupt military pay and food aid. Lawmakers say progress before November appears unlikely. Barclays reviewed its entire loan book after losses tied to the collapse of subprime lender Tricolor Holdings. The CEO said the bank had no exposure to First Brands, another bankruptcy, and has reinforced lending standards across its portfolio. He called the Tricolor hit unhappy, but said fraud risk is inevitable in lending. Elsewhere, Mattel's third quarter sales and earnings fell short of estimates as U.S. retailers delayed orders with tariff uncertainty. You can see the hit to shares there, down 5.6%. The global toy industry sources by far the majority of its products from China. That, of course, has been a key target of Trump's tariff increase. Now, despite that miss, Mattel's CEO said demand was solid for Barbie, Uno, and new Wicked dolls. Some things never change. In other earnings news, Netflix shares are sinking, taking a hit on a tax dispute with Brazil. Joining us now is Robert Fishman, research analyst at Moffettnathanson. He has a buy rating on the stock with a 1,150 price target. Robert, the company was very clear that this tax issue was a one-off. So what do you make of a share reaction that's so sharp this morning?
Good morning. So I think the stock is reacting to where expectations lie ahead of the quarter and where they ultimately delivered. So they came in line with our numbers. You mentioned the Brazil tax loss there. That creates a lot of noise. But if you strip that out, the performance and the underlying performance on the profitability of this company continues to be very impressive. And really, the question from here becomes, can the growth be sustained, not just for fourth quarter, which they gave guidance on, but thinking about next year and the years to come? And we have some pretty high confidence that the company will continue to operate at these very elevated levels.
Well, I guess there was this question, considering they have such huge hits, like K-pop Demon Hunters, like a live boxing match that they aired, that maybe they should have done better. Is in line not enough for Netflix, considering the monster hits that they had on their hands?
Yeah, again, this is a very high growth company, high growth stock. So I think that comes with high expectations, right? So basically, when you put that all together, yes, they clearly had a very strong slate. They have another strong slate coming in the fourth quarter. And you heard Ted talk about all the good shows and movies and different events coming in 26. So again, that leads us to have some pretty high confidence that the high growth will continue. And ultimately, it comes down to driving cash flow and driving profitability. And we have pretty high hopes and expectations that should continue into next year, not just next year, but really when you look out over the next few years, we think that the advertising opportunity here is going to be a significant driver to this higher level growth.
Well, they talked about this quarter being their best ad sales quarter ever. What scale does that need to get to, Robert, in order to change their growth trajectory and valuations?
So, yeah, they're in the very early innings and talked about more than doubling their total advertising revenue. But to your point, at a much lower base. So the higher that base grows, that has a more meaningful impact on the overall company's growth. And we're still in the early stages. So we forecast that advertising is going to come in under $3 billion. So again, more than doubling versus the year before. But when you look forward, we expect that to more than triple to over $9 billion by 2030. So clearly the growth there is going to be meaningful, substantial. And what that does is has an impact on the traditional television ecosystem and the different competitors, because they're taking a larger share of that TV pie. And the advertising dollars are shifting towards connected TV.
Historically, Netflix has talked and been very vocal about being builders and not buyers when asked questions about large-scale M&A. So, Robert, what do you make of Netflix's name being floated out there as a potential buyer for Warner Brothers Discovery?
That's a great question. I think there's a lot of different press reports right now going on in terms of how this is all playing out. Clearly, from a Warner Brothers Discovery standpoint, which we also recommend, there's a lot of interest, and that's a good thing. Clearly, the more interest, the higher the price it will likely end up for that company. Ultimately, we think this is Paramount, Skydance's company to bid on and to eventually win. But yes, I think that the idea that now Warner Brothers Discovery is in a full strategic review will present other opportunities, and companies like Netflix owe it to themselves and to their shareholders to take a look, depending on what the price is. That doesn't necessarily mean that there's going to be a full bid, but at the very least, just to get a chance to look at what these companies are and the assets within them. And, we'll see how this all plays out. But we think that the highest probability right now is for Paramount Skydance to end up with Warner Brothers Discovery.
Well, Robert, just to that point, CNBC reporting now that Warner Brothers Discovery rejected 3 Paramount Skydance offers. The last offer was just for under $24 a share for Warner Brothers Discovery. So to the point you're making, if I'm understanding it, Robert, is just this bid to have other people come in and make an offer for Warner Brothers Discovery, just the company saying, hey, Paramount Skydance, you need to do better?
That's where we think this will eventually end up. But again, clearly more interest is going to drive that price higher. And seemingly that's the place that we're at right now, where there's essentially an open process that the board has to clearly take very seriously, management takes very seriously, and ultimately that they have to do what's best for the shareholders. And so eventually, if there is just a bid, a very significant premium bid for just the streaming and studio assets, they very much have to consider that. But we think that Paramount Skydance has the most to gain from a potential combination with Warner Brothers Discovery. And seemingly, it looks like it was the plan all along when Skydance bought Paramount, that eventually they very much also have interest in the Warner Brothers Discovery assets to put that all together.
And nothing like a little bidding war won't help to cure when it comes to getting a higher price. Robert, thank you so much for joining this morning. Robert Fishman of Moffettnathanson. Coming up later in the hour, Workday CEO Carl Eschenbach joins us on the show to explain why he thinks HR and finance platform is, quote, underappreciated and undervalued. That discussion coming up soon. This is Bloomberg Open Interest. Under 5 minutes ago, until the opening bell, a look at futures. We are gaining just 0.1% after an unchanged market yesterday. We are just barely beneath all-time highs. NASDAQ underperforms with the Netflix underperformance this morning. While Russell 2000 futures, again, another tough morning, down 0.4%, not helped by the fact that 10-year yields have hit a one-year low. Continued correction happening in the precious metals. Gold seeing its biggest drop yesterday since 2013. It sinks another 1.5% this morning. Is this just corrective, or is it the start of a new trend? Some other movers on our radar this morning. Capital One net income jumping 80% in the third quarter. They announced a $16 billion share buyback, shares up 5.5%. Tesla, meanwhile, they're expected to post a 25% drop in third quarter profits from a year ago. That is according to Bloomberg estimates. It's trading at 195 times expected earnings over the next 12 months. And the meme stock mania is back. Beyond Meat up another 81.5% this morning. It now has a 4-day rally of almost 1,300%. Less than 4 minutes until your opening bell, we begin the trading day with Envestnet Co-Chief Investment Officer. Just moments away from the start of cash equity trading, you are watching Bloomberg Open Interest with me, Dani Berger. Matt Miller off today. Futures doing a whole lot of nothing after a whole lot of nothing yesterday. That doesn't mean there's no risks. We've had lots of earnings, some good like energy providers, some bad like toy companies and Netflix. Hence, you're seeing NASDAQ futures off this morning by about 0.1%. Russell 2000 futures off this morning as well. We're looking at NOAA opening the ringing bell down over at the New York Stock Exchange. And Master Beef. How about that? Master Beef. I'm going to be honest, I'm not sure what Master Beef does, but they are over at the NASDAQ ringing the bell. But for what it's worth, you do have Beyond Meat having a huge day yesterday, the day before. So a good day for all meat and non-meat products. Netflix, though, I said it's one of the stocks to watch this morning. Shares are down 8.5%. They had a dispute with Brazil that cut into their third quarter earnings that otherwise would have mostly beat analyst estimates. Their name has also been floated as a company maybe that might be interested in Warner Brothers Discovery. I mentioned toy makers not doing well. Mattel down 7.5% this morning. U.S. retailers have delayed their orders of toys coming in because they just don't know what tariffs will look like. Finally, Alphabet shares up 1.25%. They're in talks with Anthropic about a cloud deal valued in the high tens of billions of dollars. So sure, a little bit of shakiness when it comes to Netflix and Mattel. But besides that, in the very early days of third quarter earnings, we are on course for the best performance since 2001. About 85% of S&P 500 firms have surpassed profit estimates so far. It stands out because analysts did set the bar higher. They raised projections heading into the period. So let's bring in Dana Doria, Co-Chief Investment Officer and Group President at Envestnet. Dana, great to see you this morning. Is this a case of just the bar being low as it usually is and we're topping it, or is something else, a sign of strength, starting to emerge in this earnings season?
Well, I think you can't ignore that this is so far, it is a pretty good earnings season. I wouldn't say that the bar is low. I mean, look, we have such a high valuation in the market right now. We're priced really kind of for perfection. Now, of course, a lot of that is the top heavy, largest companies in the market. But still, I mean, this market is not cheap, by any standards. And so I think it is a good sign that we're seeing these beats, 85% to your point. There's a few cracks here and there, but they look fairly idiosyncratic. And I mean, even the financials have kind of shrugged off what looked like, what could potentially be more systemic with bad loans. And it doesn't appear to be, that so far appears to be idiosyncratic as well. So I think thus far, the news is good coming out of the earnings season.
Some of the other cracks, Dana, I mentioned Mattel. This one was interesting. The fact that retailers are not ordering in more toys because they don't know where tariffs will land us. And of course, it's a sector really exposed to China. Then there's the likes of Texas Instruments. Their CEO also said that industrial customers are also in wait and see mode because of tariffs. You do see small little pockets where tariffs are having an impact in a market that's otherwise unfazed. Could that expand beyond just a Mattel, just beyond a Texas Instruments? If this continued back and forth happens, could you actually see an impact to the overall market?
Oh, for sure. I mean, I think this, we've gone from Liberation Day to this was a negotiating stance, and now, we can kind of breathe a sigh of relief. And the market has, at this point, sort of ignored the tariff issues for the most part, right? I mean, when you get an issue like Trump promising 100% tariff on China, all of a sudden the market reacts. But largely, it's been priced in that this is not going to have a major impact on inflation, or to the extent that we've seen so far. And so I do think that there's more risk there than because, again, like, you have a market that's priced pretty high, right? So you don't have a lot of wiggle room in there for pricing. And so, yes, but on the other side of that is, do we believe that, we really are going to land in a bad place with China, or do we believe, give it a little bit of time, this is a negotiating stance like it has been before, and, we're going to have this fantastic deal? I think the wait and see is a little bit of a push on that, right? It's a little bit of a push on, we better get this fantastic deal.
Dana, it does sound, I have to say, that you are very cautiously optimistic. So if you are confident, but things look expensive, what do you do at this point? Do you sit on your hands? Do you look for cheap things if there are any to buy? Do you take profit? What's the move?
Yeah, I think that you're right. I don't see, notwithstanding an exogenous shock that's unexpected, which is always possible, given what we know about markets today, I think the base case is that, things are looking pretty good for the rest of the year. I mean, obviously, we actually are going to get an inflation report. There have been some cracks in employment. The Fed is clearly more worried about employment now than they are about inflation, which is interesting in and of itself, because, inflation, and to your point on tariffs, could continue to be a problem. It tends to come in waves. But, we're focused on unemployment, which means we're probably going to get cuts. So in the near term, there's not a lot of, immediate concern, especially with earnings coming in the way they are. People should be in the market with the money that belongs in the market. I would not be, you're seeing a reversal on gold now. I think there's a little bit of a recognition that sitting on the sidelines is not necessarily what I want to be doing. Now, of course, if you have immediate term needs for your money, that shouldn't be in the market to begin with. But I don't think we're facing, signs of some immediate pullback that would say, hey, I should take my money and sit on the sidelines.
On the gold point, because it's been incredible volatility, up 2.5% one day, falls 5.3% the next day. Its biggest loss since 2013. It's down 1.5% this morning. When you look at that, is that just, all right, makes sense, we've run up so much here, or does it say something wider about fragility in current market conditions?
I think my take would be it's more the run up. I mean, you're right. A lot goes into all of these numbers. You've got one price for all of these assets, for any asset, right? And every bit of information that's going into that, it gets reflected in the one price. So, there's a lot of reasons that things could be happening. But my take on it is just, we've had such a run up in gold. Gold does not produce anything, right? It doesn't have income. It really is just a safe haven asset. And so if you're sitting in gold, and then we've had this barbell where people are sort of in equities, and the AI trade is very dominant in equities, but it's not the only thing going on. If you're sitting in gold on the side, maybe you're pulling back a little bit. Maybe that was a little bit overbought. That would be my take on it.
Yeah, I guess it's no Beyond Meat up 1,300% in the past 4 days. We can put that to the side for now, Dana, and not try to explain the unexplainable. But you mentioned some of the event risk coming up. CPI report on Friday. A week from today, we're going to get a Fed decision, a Trump-Xi summit at the end of the month, if it does happen, and big tech earnings next week. For you, which of those do have true event risk for them? Which has the potential to be a source of volatility for an otherwise sleepy market?
Yeah, of course they all do, is the answer. But I think the inflation report's going to matter, I think, significantly, just because if things got out of hand in a way that we weren't expecting, then it puts in risk, some of these rate cuts. And I think the market at this point has kind of come to the conclusion that we do need the rate cuts, right? And so, in fact, you have some folks prognosticating about a 50 basis point, and you're starting to see that in the numbers as well, that there's a decent chance of a 50 basis point cut because maybe we were behind. And so if inflation starts to become a problem, I think this Fed does not want inflation to come back, as much as we hear dovish comments, we're worried about employment. If there's a sign that inflation really, and so this would be like, an unexpected bump. I think that would be pretty problematic. My expectation on the, tech earnings, they are priced again to perfection. But I think we're early days, this concern about a bubble or circular kind of CapEx, that could be a problem over time. I don't think it's a problem, this quarter. My anticipation wouldn't be you're going to see companies coming out and saying this is a problem this quarter. I think that's got, a long run before, you start to see a comeuppance in that. And the comeuppance would be the productivity is not happening as quickly as we would like, kind of on the other side, which is very possible. But, in terms of immediate term, I'm looking at that inflation report.
Hey, Dana, really great to get you on this morning. Thank you so much for joining Investments, Dana D'Auria. Let's get a look at your stock market this hour. About 9 minutes into your trading day, we've gone from teeny tiny gains to teeny tiny losses. Again, not that much has changed. On the winner side, you have Intuitive Surgical, the best mover by points, which is usually kind of rare for a company that's not one of the Mag 7, but they had some strong earnings yesterday that's sending shares that are highest since the 2000s. Microsoft, Alphabet, that follows close behind Alphabet, of course. We're talking about the circularity of things. They have that deal with Anthropic, a Bloomberg scoop, or at least talks for a deal with Anthropic. To the downside, it is no surprise. It's Netflix that's leading us there. They're down 8%. A tax dispute with Brazil eating into their results for the quarter. Amazon falls after it reached record highs, or Apple rather, after it reached record highs. Amazon also potentially related to that deal with Google and Anthropic, considering Amazon's an investor in Anthropic and Texas Instruments. You can see that on your screen too. They had a poor earnings result, down 8%. For the sectors themselves, a lot of earnings themes here too. You can see energy is at the top of the pile, or at least second highest. GE Vonovia, an energy company, said that the hyperscaler demand is off the charts. Usually just a boring infrastructure stock says that hyperscalers are snapping up a huge proportion of their orders to come. At the bottom, consumer discretionary. Maybe that's a bit of intel saying that the retailers aren't buying toys because we don't know what tariffs are doing. Infotech, communications, that's a little bit of Netflix in there, a little bit of Amazon too. Again, overall, we're headed towards a day that is kind of unchanged, down 0.02%. A yawn. We'll see if that changes. But again, underneath the surface, some really interesting earnings stories. Speaking of companies, Workday's CEO says that his is underappreciated and undervalued. He will be joining us next. That is Carl Eschenbach. That's coming up next. You're watching Bloomberg Open Interest. Let's get some top calls. Some of the analyst action in focus this morning. First up, 3M gets an upgrade at Morgan Stanley. The firm says expectations have reset lower, making the stock setup more constructive. Analysts see early progress from new management's turnaround efforts and say 3M could start outgrowing the broader economy. Next up, Halliburton, that gets an upgrade at RBC Capital Markets and HSBC after its strong earnings results. RBC cites the oil giant's improving capital efficiency and catalysts from its role in international power generation projects. And finally, the IT research firm Gartner is getting cut at Barclays. They flagged pressure from the Department of Government Efficiency amid the government shutdown and says macro headwinds may persist. Elsewhere, business software giant Workday is leaning into AI to draw new customers. The company unveiled new artificial intelligence agents last month and a developer platform where customers can build their own AI agents. Yet the stock is down year to date, but the company's CEO, Carl Eschenbach, says that Workday is, quote, underappreciated and undervalued. He joins me now around the desk. Carl, wonderful to see you this morning.
Good morning, Dani. How are you? Great to see you.
So what is the market missing, Carl?
Yeah, I do believe Workday is underappreciated and undervalued. And I think it primarily stems from the fact that there's this narrative in the market that AI is going to eat the software world in companies that are in the SaaS industry, like Workday. And I think the narrative is overblown, and I think it's false. So let me give you a few examples. We have 11,000 customers today. That represents 75 million users on the Workday platform. And we transact more than 1 trillion transactions a year on our platform. And with that as a backdrop and a context, we have an incredibly highly curated set of data. And as you know, Dani, your output of your AI is only as good as the data you're training off of. And we have the best data set in the industry to train off of. And quite frankly, we have a 97% retention rate, which means our customers don't leave us. And if I look at just our bookings and our billings growth around AI, it's growing over 100% a year. 75% of our customers today are already adopting our AI solutions, and 70% of our new sales, quite frankly, are with AI. AI is a tailwind for us. It's not a headwind. So I think this narrative that AI is eating the software industry and SaaS providers, and oh, by the way, I think AI is software, so we can't forget that. But it comes back to the data we have, the quality of customers. 65% of the Fortune 500 run our platform. We're uniquely positioned. And quite frankly, one of the things we announced at our investor conference, back at our user conference where we had our financial analyst day, is we made a big bet on ourselves.
Yeah.
We discussed and highlighted that we're doing a $5 billion share buyback over the next couple of years because we think the best investment we can make is in ourselves.
Well, to be fair, Carl, you've also invested a lot in AI. I mean, you're just describing some of this. I was looking, you recently announced a research center in Dublin. You've made various acquisitions around AI, including Sana for $1.1 billion. Do you think the attitude is kind of like what Mark Zuckerberg said, that the risk at the moment when it comes to AI is underinvesting, not overinvesting?
Listen, we are investing heavily in AI. We're doing it through innovation, and we're innovating one of three ways. Number one, we're organically innovating. We continue to drive a platform narrative out there in the market, and we see many partners coming to partner with us, like we announced a partnership with Databricks, with Salesforce, with Snowflake. At the same time, we've announced we're bringing 15 new agents to market. Our agents are bringing incredible business value to our customers. They're not this thin veneer of an AI agent. It's truly driving business value. And then you're right. We are inorganically innovating through very strategic acquisitions. In the last 18 months, we've made 5 AI acquisitions. And at our user conference, we announced an acquisition of Sana, which gives us an incredible opportunity to bring more AI to our customers. So we're organically innovating through acquisition. We're driving, lots of innovation to our platform, and our partners are leaning into us and innovating on top of us.
It does feel like early days, though, for some of these AI agents that you're releasing in AI-related business lines. When do you expect that to become a real meaningful part of revenue coming into Workday?
Yeah, we did discuss this in more detail at our investor conference. We talked about having over $400 million in annual recurring revenue with our agent today. It's growing over 100% a year. And I think it's already bringing value. That being said, over the next 12 to 18 months, as more of these 15 new agents that we're bringing to market come online, I think it will only help us drive more and more revenue around AI. And I think it's something that our customers are leaning into us. Our customers are telling us an investment in Workday, because they already have our platform, is an investment in their AI strategy.
I think just taking a step back, part of the fear around SaaS and enterprise software and AI comes from something as simple as Google search, right? Something as mainstay and ubiquitous as Google search was upended by ChatGPT, and they found the need to invest and make sure they incorporated AI into it. Is that representative of the industry, that if you're not acting fast, if you're not innovating with AI, you do risk getting left behind?
Oh, I definitely think that's the case, but we are doing exactly that. We're innovating at scale, both organically and inorganically, and we're bringing these solutions to our customer, on a daily basis. Our customers are leaning into our AI solutions and agents because they drive real business value. Some of our peers out there are talking about bringing hundreds or thousands of agents to market. We're not focused on quantity of agents. We're focused on quality of agents. And our agents drive true business value that our customers can measure, and that gives them confidence to lean more and more into what we have to offer.
Hey, Carl, just quickly, on this overall environment, because I saw this really interesting study from an IBM spinoff that essentially said a lot of spending by various companies is happening on AI, but 62 remain in what they call pilot purgatory. Half of enterprises can't show return on investment. I know we're talking about AI disrupting things, but is there almost a degree with some companies, and of course you work with so many, that AI is more hype than promise?
I think, there may be a little bit of hype going on with AI, but I do think it's going to provide incredible value going forward. And when I look at our customers, they're seeing the value today. It's in the early days. A lot of people are in experimental phase. They're doing proof of concepts, or they're doing tests. And during them, they're trying to figure out how to bring it into the enterprise. But eventually, there will be significant business value. tremendous cost savings, tremendous productivity gains for customers and their employees going forward. So I think while today that may be true, I think over the long term, AI will drive radical value for customers, for partners of Workday, and will drive a step function change in human productivity when people lean into it and not be afraid of it.
And hopefully not take jobs, just productivity boost.
I don't think that is going to be as pronounced as people say. I hear people out there talking about 20, 30, 40, 50% of the workforce going away. I think we're going to peacefully exist. In fact, I think AI will allow us to reskill, upskill, and revive skills that we're missing in the enterprise today, and it will drive that step function change in human productivity. Today, Dani, employees are nervous their jobs are going away because of AI, and they feel like they're competing against AI.
Yeah.
And I think that's wrong. Who they're really competing against is their competitors or peers who are leveraging AI. So they need to lean into it, leverage this as amazing technology. And with that, they'll get personal productivity gains, personal growth, and the recipient of all that is your company you're working for.
Hey, Carl, this has been so interesting. Please come join again soon. This was an absolute pleasure. That is Carl Eschenbach of Workday. Coming up, Beyond Meat shares are on a massive run in recent days. The stock just getting halted moments ago and is up more than 1,000% over the past 4 days. We'll take a closer look coming up next. Beyond Meat, up more than 8-fold in the past 5 trading sessions. The only news, marginal, an expanded partnership with Walmart. Is that what's behind it? Likely not. Bloomberg Markets correspondent Nora Melinda joins us. Nora, what is behind this rapid rise?
Well, it's really a wicked rally we're seeing right now, up more than 1,000% over the past 4 days, doubling in pre-market trading today. So we are seeing the stock really on a tear here. This is after a Dubai-based real estate developer posted on Reddit really touting the stock. So you saw so many people pouring funds into the company, and you are seeing it really just rallying nonstop. But of course, it's important to note that the shares are still down about 97% below the record high that we had back in 2019. So important to put that here in perspective, and also short interest at about 64% as of the end of September. So it is a bit of a discussion across Wall Street as to whether or not this is a little bit induced by short covering or just a rally in general. So lots to dig into right now as we continue to see meme stocks continuing to bubble.
To be clear, not a stock analyst, just someone in Dubai, and this is, I'm assuming, like his hobby or something.
I mean, it's all over Wall Street bets everywhere. So lots of retail trader action going on right now.
Definitely has that feeling like it's meme stock mania all over again. Nora, thank you so much. So great to get you on Bloomberg's Nora Melinda. Coming up in the next hour, Blue Owl's Marc Lipschultz breaks down their blockbuster deal with Meta, plus Goldman Sachs global co-head of private equity, and Josh Easterly of Sixth Street. All those conversations coming up. This is Bloomberg Open Interest. Minutes into your trading day, a whole lot of nothing happening so far in the cash trade. Welcome to Bloomberg Open Interest. I'm Dani Berger. Matt Miller is on assignment this morning with the market just inches away from all-time highs, but seemingly not able to get there. Coming up on the show, investors weigh a mixed bag of earnings while Beyond Meat joins the retail trading frenzy. And the Fed floats a plan with much smaller capital hikes for Wall Street's biggest banks. Plus, government gridlock, the U.S. shutdown is now the second longest in history as talks stall. We begin with early third quarter earnings, pointing to the best corporate results in 4 years. That's according to data compiled by Bloomberg Intelligence. I caught up with Dana D'Ora of Envestnet earlier this hour.
So far, it is a pretty good earnings season. I wouldn't say that the bar is low. I mean, look, we have such a high valuation in the market right now. We're priced really kind of for perfection. Now, of course, a lot of that is the top heavy, largest companies in the market. But still, I mean, this market is not cheap, by any standards. And so I think it is a good sign that we're seeing these beats.
Michael Ball, Bloomberg macro strategist, joins us around the desk now. And Michael, I guess it's one of those things where we're like, it looks good. Nobody blink or say anything to jinx this at the moment because we're still in early days. But what have they shown you so far? Yes, there is strength, but is that strength even for earnings?
Yeah, so far it's good. There's no red flags. I, again, really liked what I saw from the banks, both the regionals and the large caps. But there is still this narrative where the middle and lower income are being sort of stressed, and there is a worry that they aren't keeping up, and that future margins and earnings will be coming off because of that. So the K economy still is being displayed here, whether it's for the Coca-Cola and sort of front-facing retailers or even from the banks themselves. And I guess we had a continuation a little bit of that today with Mattel, who also is saying they're having some problems passing on. And separate from that is also that China is still lurking in the background, meaning that, yes, we're having a better inflationary story going into year end, but these tariff pressures are still there hanging over. So the two takeaways I'd say was that there's a K economy still occurring and the inflation pressures are still coming.
And it wasn't just Mattel, I should say, that flagged issues around tariff and trade policy. We also heard from Texas Instruments that said a lot of their industrial customers are in wait-and-see mode because of that. Does it mean that the market too quickly overlooked some of the tariff concerns? We are back basically where we were when Trump had that post on that past Friday about additional tariffs to China.
Yeah, and Texas Instrument is telling us what PMIs have been showing. And if you look at some of the comments across the Fed regional ones or even the ISMs, it is this, we don't know, we have little bit of confidence. And even NFIB, still high level of uncertainty from small businesses, holding off on investment. So everything outside of AI is still sort of on pause.
Everything outside of AI is on pause. But then people would point to AI and say there's a frenzy going on. People would point to Beyond Meat and say there's a frenzy going on. Meme stocks are back. Is there this feeling of getting back to those days when people were in their basements trading? Is there some sort of froth and exuberance still present in this equity market?
Yeah, I'd say in the equity market, it's coming up in pockets. We've certainly seen call skew move up over the last few weeks, and then we've had sort of that blow off last Friday with Trump's China comments. And when we look at the pocket, like something like Beyond Meat, it's an interesting, like a huge short interest. Guy comes out on Reddit, says, hey, look, this is cheap. There's something still to this business. It's being oversold, and boom, you get this YOLO crowd coming back in like we saw in 2021. So it's kind of exciting again to see that in some ways because it's a fun story. But overall, there's less of a short interest broadly out there for this squeeze to go to other names. You look at AMCs and the GameStops and some of these normal characters, and they're not really participating. But interestingly, single stock vol is still rising somewhat. So, index vol is coming back off. We all look at the VIX, but there are pockets within the market that have higher vol implied, meaning that you can see pops in individual stocks more easily.
What do you think is behind that? The fact that on the surface everything looks calm and underneath that's not the case?
Well, we've had systematic selling of vol throughout most of the post-April rally. That obviously took a break last week when we saw the VIX move up to 28. It's coming back in now, and you're seeing some of the sell-side guys who can see the flow commenting on that. You are returning back to a zero DTE pressure where they're selling basically straddles and looking to move the implied vol for the day lower and trying to take advantage of that. It had a high Sharpe ratio for most of the year, and now that trades back in, and that's going to work on the overall index, pushing the vol down for index and having the melt up go up.
Michael, brilliant as always. Thank you so much for joining this morning. That is Bloomberg's Michael Ball. A quick check on markets about half an hour, a little bit more than that, into your trading day. Markets, and to Michael's point, not a lot of volatility on the surface. We are barely moved for this S&P 500. We are up just 0.02%. The NASDAQ, though, that is lower by 0.1%. Might have to do with some of the earnings underneath. And speaking of which, some of the single stock movers this hour, it's Netflix. Netflix is, of course, what I was referring to. They said a tax dispute with Brazil cut into third quarter earnings that otherwise would have beat estimates. Those shares falling this morning off the back of that. We also had Mattel earnings that disappointed. Michael was talking about Mattel, too. That was Netflix, down 8.7% this morning. Meanwhile, Mattel down 4%. They said that retailers weren't restocking for the holidays because of tariff uncertainty. And then finally, Bloomberg learning that Google is in talks with Anthropic for a cloud deal. That one billed and valued at tens of billions of dollars. Google shares, Alphabet shares have been higher off the back of that. And Amazon shares, those have been falling off the back of that. Google so far this morning, let's see how much it is up. It is up 1.5%. Let's stick with tech and with Meta specifically, and Blue Owl, which has secured a $27 billion private capital deal with the tech giant, with Meta, for their new data center in Louisiana. I spoke exclusively with Blue Owl Capital co-CEO Marc Lipschultz about that massive agreement.
It was difficult to, I'd say, innovate together with Meta. That is to say, it's new, it's groundbreaking, as you observe. It's a scale no one has dealt with. But Meta is an incredibly innovative company, right? So this is a beautiful marriage of a deeply innovative company meets, this sort of need for innovative capital solutions, which certainly we think of as our calling card at Blue Owl. And so together we're able to craft something really bespoke at a scale that nobody has seen before. And that is exciting. And they have a great team there. The CFO, Susan Lee, and the team, Todd Hesse and Michael Hart. I mean, they're really good at what they do. And working together, we're able to do something that really worked for them and creates a great investment for us.
There's a lot of excitement around AI, and I think a lot of players would also look at Meta as a counterparty and also be excited by that. How competitive was this deal?
So I do think at the end of the day, partnerships will define this industry for the foreseeable future. And that's because it isn't just about capital. I mean, yes, capital is a necessary and important component, and in quantums that people are not used to, but it isn't just capital. It's capital married with knowledge, capital married with skills to be able to craft a solution. It's not just a generic building. You have to picture the magnitude of what we're all talking about, right? This is a 2 gigawatt complex. So just to frame that, that's more than a big city in America consumes in power in one site. This is the largest data center complex being built, as far as we know, in the world today. But remember, it's bigger than the one we announced 3 weeks ago, the Borderplex project. That's $22 billion, which is bigger than the one we had before that, which is Abilene, Texas, which is $15 billion through phases 1 and 2. All of those are Blue Owl solutions. All of them are different because in the case of, say, Abilene, you have Crusoe, who's a fantastic developer partner. So there, we're partnered to a developer in putting together that massive and successful project for Oracle. In Borderplex, we're building it internally. We have our own business called Stack, 1,000 people captive that does the developments of very complex projects. So Stack is developing, Blue Owl as the capital partner, the Borderplex project. Here, Meta is going to build and going to operate the data centers themselves. So those 3 different flavors, all of them require a different customized solution, all of which require really deep knowledge on the one hand and really deep access to capital. And we have uniquely brought those 2 together. And so I think people know if they come to us, we can deliver all the capital, one-stop shop with the knowledge you need to do it right.
So as the deals get bigger and bigger, again, this one, $27 billion, how do you make sure, just given the sheer size of it, that Blue Owl as a whole isn't overly dependent and exposed to be it just this individual deal or these AI deals you're making?
Yeah, well, so people that here at Blue Owl, like our business is built on risk management, diversification. In fact, our whole business is about downside protection. So it actually comes natural for us to be thinking about where are all the different pockets of risk and how do we manage them. Now, very importantly, in this space, different from most others, you got to remember we're dealing with the companies that are the biggest companies in the world with the best credit ratings in the world. So there is a different question when it comes to concentration. That is to say, having a lot of exposure to Microsoft, a lot of exposure to Meta, a lot of exposure to Amazon, those are pretty darn good exposures.
Blue Owl Capital co-CEO Marc Lipschultz speaking with me about his company's $27 billion private capital deal with Meta. Coming up, more private capital. Michael Bruun of Goldman Sachs Alternatives on what he calls a constructive moment for private equity. That conversation coming up next. You're watching Bloomberg TV. Turning to private equity, momentum is picking up in deal making with Goldman Sachs Alternatives, noting that global M&A volume is up 31% year to date, standing at $3.5 trillion. Joining us now, I'm pleased to say, is Michael Bruun, global co-head of private equity at Goldman Sachs Alternatives. There on the heels and amidst the Goldman Sachs Alternatives Summit. Michael, wonderful to see you this morning. Talk to me about this optimism. The deal volume is back up. Is it the all clear? Are we off to the races?
We certainly, good to see you, Dani. We certainly think that deal-making volumes are back for very fundamental reasons. First of all, private market valuations have stabilized. At the same time, you've seen volatility come down, and importantly, you've seen base rates reduce and credit spreads reduce. And so if you think about that from a private equity return equation perspective, that just leaves more room for equity return formation for private equity. And so that's a big part of what's driving deal making at this moment in time. And as you noted, both overall M&A volume is up, but in particular, we're seeing that private equity-led deal volume is up significantly year to date. And that is definitely driving a moment of optimism also at our 2025 Goldman Sachs Alternatives Conference.
It's back, but does it reach new records, Michael? Do we ever get back to the deal environment, the frenzy of 2021, for example?
You're right. We're not back at where we were in 2021, and I think it will take some time. One of the things that we look a lot at is how much of the overall net asset values of private equity funds are being monetized every year, and we're certainly running below the historical assets, and that means that average hold periods have extended from 4 to 6 years roughly in the private equity space, and that means that there's a very large backlog of opportunities for those of us who are in the market looking to buy assets. So we think that we're not quite there yet. I think it will take more from monetary policy and maybe even tighter credit spreads to really get the volume back. But we certainly see it as a more constructive environment, and we certainly think that that backlog will allow for a lot of interesting deal formation on the buy side. Interestingly, at this moment in time, we are also seeing a lot of corporates having to focus their businesses. And so we see a lot of very, very interesting corporate carve-outs. Carve-outs is one of the segments of the overall M&A market that's also up this year. And it's something that we're particularly interested in because we can really get in there and help these corporates in their non-core business and
Michael,
make them focus on their core
Part of the
segment.
reason I ask about 2021 is this question of, okay, there's been some indigestion. To your point, we could get better if things like rates come down. But was 2021 an anomaly, or should we be viewing that as a historical norm and something that we can get back to?
I think that 21 was an outlier, but I don't think that we should think about, say, the deal volumes that we observed in, say, 23 as the new norm. I think that we can get up into a segment that is somewhere in between those two levels. We're also seeing new capital coming into the market. We're seeing retail capital coming into the market. So there's certainly capital that want to get deployed, that want to be part of the alternatives deal formation, this very intense micro focus on driving company value. And so therefore, I think there's hope for the industry that volumes will continue to pick up.
Michael, I would love to get your take on this Bloomberg story we had yesterday, this really interesting scoop that OpenAI essentially hired a bunch of banking analysts in the hopes of developing generative AI that could do the grunt work of financial analysts, associates, what have you. In the work you do, could you see a future where that is true, in a near-term future where AI replaces a lot of the work in financial modeling that more junior analysts and associates do?
It's interesting, and I think there's definitely elements of the overall value creation playbook that is open for disruption or, seen from our perspective, enhancement. If you look at overall productivity improvement potential, Goldman Sachs research thinks that more than 25% of all jobs over time will be replaced through the use of AI. And we certainly see that a certain level of AI implementation in our own industry is needed and warranted. And so, yes, I do think that some of the more kind of computational task and say maybe more entry-level task will get disrupted by AI. Having said that, I think it takes a lot more to generate strong investment returns than just being able to compute or calculate things, right? You need a strong network, you need differentiated deal making, you need very strong value creation resources. So the value creation playbook for private equity is a lot more complex than I think that AI can solve for us over the next few years.
Is there any element, though, of AI you're currently using in your investment process now, though, Michael?
Yes, absolutely. So we are using AI fundamentally in two places. We're using AI when it comes to scanning new investment opportunities, and the more data you have, the better decision making you should be able to make. And we are introducing AI in areas where we can learn from the past, and we can learn from a very, very large data sets that we have proprietarily at Goldman Sachs based on all our experiences so far in investors. So that's definitely a very important area of AI implementation. But what fascinates me the most at this moment in time is what AI is doing for our companies. You need to be very deliberate in your approach to AI because you can quickly get lost in the world of AI. But if you have experts helping you, we have tons of data scientists, we have Goldman Sachs engineering people coming into our investment business, assisting us and assisting our portfolio companies. And if you allow those resources to be deployed in select areas, we see opportunity to drive both revenue growth and EBITDA growth. And that's ultimately what it's all about in terms of driving intrinsic value in these companies. So this is probably, we're talking a lot about it at our conference this week. This is probably the one single area that we are most excited about from a value creation perspective.
Hey, Michael, never enough time with you. And I know I got to let you get back to the conference, too. Thank you so much for carving out some of that precious time for us this morning. Michael Bruun of Goldman Sachs Alternatives. Still ahead on the show, the Fed is considering a plan with smaller capital hikes for big banks. Details on that Bloomberg scoop coming up next on Bloomberg Open Interest. Now to a Bloomberg scoop. The Fed has floated a plan with much smaller capital hikes for Wall Street's largest lenders, that according to people familiar with the matter. Joining us now is Bloomberg's chief Wall Street correspondent, Sri Natarajan. Sri, what exactly is being floated and how different does it look from the plans from the Biden administration?
So let's take a step back. The only reason these plans are even being considered is because there was a push to have this international banking capital standards. That framework was the desire there was to figure out a proposal and a mechanism that would make banks more resilient, would make sure that they can be well shielded through market shocks and market stress. But the original proposals that were unveiled now about 2 years back call for something that would have required, for at least for the biggest banks, an aggregate increase of roughly 19 to 20% in their capital requirements. That led to some wild uproar, the kind of visible public lobbying from banks that we've rarely ever seen. And even by last year, even the Biden administration had climbed down. Their revised proposals called for a 9% increase. But the elections changed all that. With everything that you've heard from big business and their attitude toward the Trump administration, the banks got an extra fillip because of their view towards deregulation. And when they replaced the Fed chair for a vice chair for supervision, Michael Barr, clearly not a friend of the industry, the banks made that extremely clear. With Mickey Bowman, who the banks do see as a friend of the industry, there was a lot of cheer, and you could see that in the market. Bank stocks have been climbing up pretty consistently through the course of the year. The biggest increases like Citigroup, Goldman Sachs, JP Morgan, Morgan Stanley are all in the 30 plus range. So they've done really well. So the expectation was that when they revise their capital proposals, it would be much more friendly for the banks. And that's what we're hearing now, that what they will formally float early next year would be an aggregate increase of roughly 3 to 7%, a world away from the 20% increase we were thinking about just 2 years ago.
I mean, especially if it ends up being something like 3%, that is a much easier environment for them. What do you make of the fact then that Goldman's down, Citi's down, Bank of America is down? They all initially popped higher on this announcement. Are you surprised that there's not more shareholder enthusiasm over these rules?
So you're right to say that the market reaction this morning has been muted, but you have to weigh that against the fact that through the course of the year, they've had a big run up. So the expectation was already baked in. What I'm more interested in is the fact that when they say on aggregate, the big banks will have a 3 to 7% increase, would that affect different banks in a wildly different manner? We have a line in the story that says lenders with large trading portfolios, that is how the capital proposals would judge market risk, could see some of the requirements not climb as much as the others, or perhaps even decrease. Could that mean that a Goldman Sachs or Morgan Stanley could see a decrease, and a Wells Fargo see a bigger increase than the 3 to 7%. So I think when we talk about the market reaction, the real reaction could potentially come when we get the details, and the details will run hundreds and hundreds of pages. When we get the detail, will there be enough of a dispersion in how the different large banks are treated? And there we could see some divergence in their stock moves.
Sri, could you just help us explain? So the range that's been given is 3 to 7%. How different those two numbers are in affecting the bank's businesses?
Well, just in terms of perception, market was expecting a 9% aggregate increase. So if the aggregate increase was roughly to be 7%, perhaps not that much, but only 3%, that is a big difference. At the end of the day, we're all wondering, would banks have extra capital on their hands, and what will they be able to do with it? Would that mean more buybacks? Would that mean more incremental acquisitions? We've already seen big banks talk about it. We've just seen Goldman Sachs take a nibble at $1 billion acquisition recently, and others are perhaps thinking about something like that. Or could that just mean more money to spend on technology investments? That's where the difference between a 3% increase in capital requirement and a 7% increase could make a big difference. And a bigger difference is there are some folks who actually see a decrease in their capital requirements, whereas some see a bigger increase.
All right. Always great to get you on, Sri. Thank you so much for explaining that. That is Bloomberg's Sri Natarajan. Coming up, we talk private credit with power player Josh Easterly of 6th Street. That's coming up next. You're watching Bloomberg Open Interest.
The real question at its heart is there some sort of forthcoming, challenge? None that we can see. Are there indicators of a challenge? None that we can see. And do remember, none of us live in a vacuum. So we're talking about an incredibly healthy equity markets, incredibly healthy bond markets. We're not living in isolation. We're part of that same ecosystem. And it is an ecosystem, right? What the banks do, what we do, we're all part of an ecosystem.
Blue Owl's co-CEO Marc Lipschultz speaking about the war words that broke out after Jamie Dimon's cockroach comments, joining us yesterday. Joining us now, another power player in private credit. It's Josh Easterly, co-president and co-CIO at 6th Street. His firm manages over $125 billion in assets. Really great to see you this morning, Josh.
Thanks, Dani, for having us.
And look, there are some nerves in the market. BDCs as a whole, for example, are down on the year. I don't think you'll mind me telling our audience that you're outperforming and you're one of the few that trades at a premium to book value. Yeah. Even so, though, are some of those fears warranted? Maybe not that there's a systematic issue, but maybe that we're late cycle and accidents happen when you're late cycle.
Yeah, I don't think it's late cycle. I actually don't think it's a credit issue. First of all, we've been managing our BDC since it was formed in 2010, managed it since 2011, and went public in 2014, and have outperformed the market. What I would say is, I think investors are finally waking up that given rates are rolling over and new spreads are a lot lower than old spreads, that returns are going to be a lot lower in the future. And as investors, they should only care about the future, not the past. And so I think that's the issue. We wrote about that in our April letter to our investors. And I think that there should be a signal to the space that they need to think about their cost of equity, and that should roll through and cure itself at some point.
Right. Again, you've flagged, as you noted in April, that it's an asset class that's bound to disappoint. What does disappointment actually look like?
I think disappointment if people earn less than they thought. I don't think they lose capital. I don't think there is an expected. They just have disappoints on expectations. And I think you keep hearing this argument between banks on private credit and private credit managers. I think both can be true, which is private credit can disappoint. I think that's what the banks are saying. And maybe there are managers that will disappoint given the proliferation of the asset class. And banks are trying to protect their big profit pool on high yield and leveraged loan underwriting. So I think both those narratives can be true. It's not one or other, and you hear both. We think the key is having a big platform and being able to move from asset class to asset class where we don't have to do direct lending if the risk reward is not right. We control top of the funnel and continue to move and shuck and jive through asset classes as risk reward changes.
On that point of having to deploy capital, how much more acute are those pressures with the fact that this is also an industry going through a massive shift and trying to bring in wealth capital? Yeah. When that comes in specific funds that needs to be deployed, how much more greater do the pressures get to deploy, and maybe at the sake of returns?
Yeah, I think you have two choices as an investor, what to invest in and when to invest. And I think if you manage retail capital with a narrow investment mandate and large scale of it, you lose both those choices. You have dollars coming in and you have to invest it, so you lose the when and the what's on the menu that day. It's not like you can wish for something different than what's on your pipeline. I think the design that will be a winning design, which in our mind will be having, if you're managing that type of capital, having a broad base of opportunity sets and a multi-strat platform so you can choose relative value I think that's the winning formula, but time will tell.
So in that formula, and again, I assume that this is the formula that you're pursuing at Sixth Street, you can avoid those pressures. For those that can't avoid those pressures, does this industry lose a lot of its alpha? Does alpha turn into beta when you're just investing in whatever you can?
Yeah, look, we've been managing that strategy for our institutional investors in a fund called TAO, which is about $30 billion for, I don't know, almost a decade. And so that formula works really well for institutional investors. You know, could it possibly translate to other investor sets? Possibly. I think over time, the challenge with investing is when there's outsized returns, those returns dissipate, they look more like beta, and you have to keep moving. And so you have to build a platform that allows you to keep moving. That is culturally hard, and that takes a large investment to have the teams that are across asset classes and across strategies. And we think that's a real barrier to entry.
Can we also just talk about the cultural shift of marketing to wealth? Because this is an industry that's kind of been known to be exclusive. To have institutional clients come to you, how different is it for that to be flipped on its head?
I got a little slack for a comment I made a couple of weeks ago.
You indeed did. You were talking about sports marketing. Do you want to clarify some of those comments?
I would say it's not marketing or advertising. My point was that is a canary in the coal mine, that the sales channel is changing, and it is a product that is sold and not bought. Our historical base of investors were institutional investors that had a wrapper around it, that had professional allocators of capital and consultants, and they actively chose investment strategies and managers. They didn't choose because they saw a brand on a TV or that it was pushed towards them. So the canary in the coal mine of that change was that people were advertising. I don't have a view. I'm not an advertising person. I don't have a view of, you know, one form of advertising is better than another form. I'm just saying that is a shift, and ultimately strategy matters, and architecture matters, and culture matters, and investment and experience for the underlying client will win the day. But I think that is, you know, you're going to need information, and you're going to need time, and you're going to need transparency, and that will take time in the space.
So if we are in this scenario where big marketing pushes are happening, the asset class is one that's being sold and not bought. You and I have talked about this idea of trust, of how important that is to this industry. If all these things are happening, and that's coinciding with a period when returns are about to not look as rosy, is there an issue of trust erosion?
I think that is the real, look, financial, I now understand this managing a financial services firm. It's all about trust. And the firms that do what they should do versus do what they can do will ultimately create trust with their clients. And that should be everybody's aim, because you do not want to hurt that investor base in the long term. We're lucky enough, we've been at this for 16 or 17 years. We got 20 to 30, 40, 50. Legacy is really important. And to have a legacy in this business, and given the age of our partners, trust and creating trust really matters.
Before I let you go, I'd be remiss if I didn't ask about some of your sports investments. You have a wide variety in different types of sports, whether it be more emerging, whether it be some of the big leagues in the U.S., the sports themselves, some of the event companies around them. Looking forward in what's attractive to you now, is it this widespread, or are there certain parts of the sports industry that you're concentrating on?
Yeah, so we think the ecosystem is really interesting. They're generally great business models that are they don't lack competition, but the leagues themselves don't really have direct competition. And we believe that the first ones in will ultimately win, but we're going to do it in the Sixth Street way. So we bought AV rights on a soccer league in Europe. We did a stadium financing for Real Madrid. You know, we own a service provider in the space. We're going to do it in the Sixth Street way. We were early on the San Antonio Spurs. We think the ecosystem's interesting, but we're going to do it in a Sixth Street kind of alpha way.
I said, do you want to make some news? I know your name's been floated with the Patriots in association with them.
I don't know what's out there, so I don't want to comment on that.
Josh, very diplomatic. Yeah. We will end it there in that case. Thank you so much for joining. Really wonderful to see you. That is Josh Easterly of Sixth Street. All right, let's quickly get a check on these markets over an hour into your trading day, and we have turned decisively lower. We're down by 1/3 of 1%. 1%. We're down 0.7% for the NASDAQ. Netflix hurting there. And you are looking at 10-year yields. Those have flipped from gains to losses, with a 10-year yield now up a basis point. Maybe that's what's dragging stocks down with it at 397. Meanwhile, spot gold has another tough day after its worst day since 2013, falls 2%. A quick look at some of the single stock movers in this hour. I mentioned Netflix. It is sinking. It took a hit on a tax dispute with Brazil. In the past hour, we had Moffettnathanson's Robert Fishman, who said he has pretty high confidence that Netflix's high growth will continue. He continues his buy rating maintained on Netflix with a $1,400 price target. Texas Instruments, that gave a disappointing forecast, suggesting that customers are slowing orders amid trade tensions and a shaky economy. Shares off nearly 6%. And Tesla, they are set to report results after the bell today. It is expected to post a 25% drop in the third quarter from a year ago, according to our own internal estimates. Coming up, the government shutdown enters its longest one since U.S. history, the second longest one, I should say, in U.S. history. There's no end in sight. And the U.S. giving Argentina a $20 billion lifeline. We're going to talk about what's at stake in the country's elections. That's coming up next. You're watching Bloomberg Open Interest. The government shutdown has hit day 22. That is the second longest ever, with talks frozen over healthcare funding. Workers are set to miss their first paychecks this Friday. Let's get the state of play with Bloomberg Washington correspondent Tyler Kendall. Tyler, where do negotiations stand?
Hey, Dani. Well, at this point, Republicans are really holding the line that they're not going to have any negotiations until the government reopens. And we saw that stance really bolstered by President Trump yesterday after he met with Senate Republicans at the White House. Now, Democratic leaders are trying to get on President Trump's schedule before he heads out of town this weekend for his trip overseas to Asia. But ultimately, President Trump says that while he's open to talking with them, signaling some hope that there could be a health care deal down the line, he's maintaining this red line that he's not going to talk until the shutdown ends. Republicans argue that they have time to address really the core issue here, which is those expiring Affordable Care Act tax credits set to end at the end of the year. And that's because the expiration date is at the end of the year, even if open enrollment is starting on November 1st. This is going to be an issue that keeps dividing Republicans on exactly how they should tackle these tax credits once those negotiations do get underway, because keep in mind, many red states chose not to expand Medicaid, which means that there are likely more people in those states on Obamacare insurance exchanges. Now, we have seen at least one off-ramp floated from Senate Majority Leader John Thune, who has promised an up and down vote, as it's called, on extending these tax credits for at least 1 year. But Democrats say that's not enough because it's no guarantee that that would pass. And it's also not even a guarantee that there would be a vote in the House. And of course, both chambers would need to advance this legislation for it to get done. Basically, the synopsis here, Dani, is that the House has been out of session here in Washington since September 19th. Tomorrow, we're expecting the Senate to adjourn for the weekend, and President Trump is going overseas for a week in Asia, which means that this shutdown is likely going to drag on into at least a fourth week.
One of the other concentrations of this White House has been what's happening in Argentina, and Scott Bessent in the Treasury readying a packet to help rescue them. Bessent talked about a $20 billion swap deal. Tyler, how close is that to being finalized? Do we know?
Right. So in addition to this $20 billion swap deal that we saw some of the details come out this week, including that confirmation from the Treasury Department, we know that the Treasury Department is also floating this additional $20 billion financing deal with banks. This includes J.P. Morgan, Bank of America, Goldman Sachs, and also Citigroup, according to people familiar with the matter in this new story that's out on the Bloomberg terminal today. But key details, including the debt's term, structure, and collateral, remain unaddressed. One of the biggest questions here is whether the U.S. is going to provide some sort of guarantee. And it's leading to doubts because we actually are up against some sort of a deadline here, right? This is considered to be a lifeline for Argentinian President Javier Milei as he tries to regain investor confidence, but also notch some political wins for his party ahead of this weekend's midterm elections. More than half of the seats in Argentina's Congress are up for election, and we know that Milei is trying to score some political wins. Dani, of course, this move is largely seen as a way for the Trump administration to prop up a key ally in the region. As we know, China's made really significant inroads there. Just look at the fact of how China has been importing those soybeans, while American farmers, which relates us all back to the shutdown, haven't seen any of those U.S. supplies get through.
Tyler, thank you so much for that. That's Bloomberg's Tyler Kendall in Washington, D.C. Joining us now for more on what's at stake for Argentina's markets ahead of this election the weekend, Gustavo Medeiros, head of research at Ashmore Investment Management, joins us now, which does invest in the country. Gustavo, thank you so much for joining this morning. So Tyler said it there. The clock is ticking with a midterm election this weekend. Do you think that Scott Bessent and the Treasury will be able to put together and implement this package ahead of it?
Well, they have half a business day, right? So it doesn't look like, I don't think it's necessary for them to put the package ahead of it, actually. I think all it's necessary is that you have a plan and you execute and you're supporting Argentina. I think it's pretty, if you'd have asked me a month ago that whether or not the Treasury of the United States would be talking about a $40 billion package to Argentina, I would have said no way. It's almost unprecedented. We've seen the U.S. supporting Mexico during the tequila crisis in 1994. Back then, liquidity came with strings attached in the form of oil export guarantees. Now you have a $20 billion swap line with no strings attached, and we're talking about a swap, actually a credit line to buy back bonds on the secondary market. Argentina could save a ton of money because bonds are trading below par. And by the way, the toughest part of the job, Javier Milei has already done. There has been 2 years that he's done the most aggressive fiscal consolidation of any G20 countries that I've ever seen in 25 years of investing. So I think that people are making, this is Argentinian elections. There has to be some drama, but people are making a bit of much bigger of a drama than it should have been.
Well, I guess there's also this question, even with this support, there are structural issues in Argentina, whether it be liquidity, inflation, debt. So does this actually even fix their problems?
Well, they fixed that problem already because they are running now a primary and an overall surplus on the budget. So if you actually look in debt sustainability terms, which is all that investors should care, that debt to GDP is going to be declining within the next 5 years, given the fiscal adjustment that has been done over the last 2 years and what is still going to be done by the next 2 years of the Milei administration. He will most likely remain in power for the next 2 years. And what Argentina has is a liquidity problem related to speculation against the Argentinian peso. Investors and locals didn't like the band, they didn't like the currency regime that was designed to bring inflation down. There is some merit to this criticism, but ultimately is a confidence issue. And that's why the $20 billion swap line is a game changer, because it's the U.S. Treasury. Before, you were speculating against the government and the Central Bank of Argentina, which a lot of locals and internationals have done successfully for 30 years. Now you're speculating as well against the U.S. Treasury, and I think that's quite a gamble.
And to that point, when you have seen announcements of the U.S. supports, there have been moments where the peso has fallen, that the reaction hasn't been straightforward. So you're saying now that you have this $20 billion swap line, you feel comfortable in going long the peso, that is a game changer for how you actually invest in Argentina?
I think you have to wait the result of the elections to see if they're going to change the FX regime, right? The peso really depends on the total return. The currency traders, I'm not a currency trader myself, but I work with a bunch of them, and they're really keen to see what's going to happen next week, right? Because if the currency is going to devalue by 5, 10, 15%, then, well, that can hurt them a little bit in the beginning, and they want to see what's going to happen post-elections. Will they change the currency regime? But I think whatever happens, the currency is very likely to find stability after the election, after a revamp or not of the currency regime comes through, because this $20 billion is a lot of the monetary basis of Argentina. We're talking about close to 20% of all deposits and currency in circulation, the ballpark level. So that's, again, and they had reserves before that because the IMF gave them a very large package. So we're talking about gross reserves that could actually cover 40 to 50% of the monetary basis. So that's very large. And I would imagine that a speculation against the peso, given what's happening within the last couple of days, have been to a very large degree as well. So I wouldn't be surprised at all if the peso strengthens after the election.
Gustavo, you started out this conversation by saying this is unprecedented, this amount of support from the U.S. It's abundantly clear what Milei gets out of this. What do you make of why the Trump administration is offering this unprecedented amount to help prop up Argentina?
I think your colleague alluded to, right? The ideology that the Trump administration has. What Trump is trying to achieve is to get the private sector going again. And GDP growth accelerating here would allow the U.S. to get out of its twin deficits massive hole, that if it would be an emerging market economy, it would be in a very, very deep problem. Javier Milei has the same idea. He believes in economic freedom. So he wants to get the government out of the way. He wants to reduce the size of the debt. He wants to reduce the size of the deficit permanently so that actually the private sector can come and thrive and flourish. And actually there's a lot of signs that you have a large pipeline of FDI that is actually a lot of that coming from America. So, and I think it's important from a geopolitical perspective that Latin America becomes a successful economic model. Because if you think about the immigration problem that the US has, most of that is related to how poorly managed Latin America has been on average within the last 15 to 20 years. That doesn't create economic opportunities for a local population, and this local population is trying to find a better alternative. People make a big fuss about the soybeans. The soybeans, Americans haven't been exporting soybeans to China for different reasons, because of the trade war. China is using the leverage that they have. The fact that the US is actually supporting the peso didn't change the trade in the soybeans at all, right? So I think politically makes a lot of sense.
Yeah.
For historically, the US has had a policy of having a lot of stick against Latin American countries. You need more carrots. You need to incentivize these countries to deliver higher GDP growth, and I think that's what they're supporting, a regime that is actually already doing that by itself.
All right, Gustavo, thank you so much for joining. So much more to ask you, but unfortunately we are out of time. That is Gustavo Medeiros of Ashmore Investment Management. Thank you so much. More Bloomberg Open Interest coming up after the break here, over an hour into your trading day with stocks looking weaker. Nearly an hour and a half into your trading day, and we are unable to sustain gains on this equity index after an unchanged day yesterday. We're down by 1/3. To the upside, you do have some earnings coming in. Microsoft, they didn't have earnings, but Intuitive Surgical did. They had earnings. Alphabet, that was a deal with Anthropic. That's picking up those shares. To the downside, because this is what's moving markets lower, Netflix is having a really big impact here. 6 points lower is how much it's dragging the index down, just under 10%. Amazon, that also falls, maybe because of that Anthropic Google deal. They are an investor in Anthropic, and Apple takes a break from its all-time highs. When it comes to the sectors, again, it is tech that is lower because of some of those nerves there. Energy, that is the top of the pile thanks to earnings from GE Vonovia, because the hyperscalers are buying a lot of energy. I just want to leave you with this before the end of the hour, and that is the volatility that we have seen in gold. Look at this. This is what it's done so far this week. It is down 4.6%. It's down yet again this morning after falling more than 3% yesterday. Its worst day since 2013. A lot of volatility. Okay, coming up tomorrow, we're going to talk Tesla earnings with BNP Paribas Exxon, plus Ann Berry of Threadneedle Ventures and the CFO of American Airlines. That's tomorrow. This is Bloomberg.